Hello friends, my name is Hasnan Khan and welcome to my YouTube channel Edge Over Luck. In today's videos we are going to talk about fundamental analysis, not just for definition but to help you understand the market with real reason behind its move. Many people think fundamentals are only about news or just interest rates announcement, but the truth is fundamental analysis is the backbone of the market. First of all, let's clear one very important thing. Fundamental analysis is not about the predicting the future, it is about understanding why the market is moving. Whenever the market makes a strong move, there is always an economic reason behind it, whether it is interest rates, inflation, or overall strength of a country's economy. In the forex market, we trade currencies, and currencies actually represent the economy of the country. A strong economy means a strong currency, and the weak economy means a weak currency. That's why fundamental analysis helps us understand which currency can remain strong in the long term and which one is likely to weaken. One of the most important part of fundamental analysis is interest rates. When a country has high interest rates, investors prefer to move their money into that country, and when interest rates are low, money flows out. That's why interest rates decision can move the market within seconds. After that comes inflation. Inflation means whether prices are rising or falling. If inflation are under control and the economy is stable, the currency usually remains strong. But if inflation too high and out of control, the currency weakens no matter. That's why what the chart may shows. When we have employment data, jobs data tells us whether people are working or not. More jobs mean a stronger economy and stronger consumer spending. That's why employment reports have a strong impact on market sentiments. Now, friends, if we do not talk about major economic events, fundamental analysis remains incomplete. In the forex market, there are three very important news events: NFP, CPI, and PPI. NFP, non-farm payroll, which is usually released on the first Friday of every month, shows how many new jobs were created in the US economy. A strong NFP usually means a strong economy and often a strong US dollar, while a weak NFP can completely change the market direction. Next is CPI Consumer Price Index, which is usually released around the middle of the month. CPI measures inflation, and inflation is what drives central banks' interest rates decisions. That's why the market becomes very volatile on CPI days. Then comes PPI, Producer Price Index, which is often released before CPI. PPI measure inflation at the production level and often acts as an early signal for CPI. That's why smart traders never ignore PPI. Professional traders do not trade these news events blindly. Instead, they mark these dates in the advance and either reduce risk or wait for the market's reaction. When you combine fundamental bias with technical analysis, trading no longer becomes guessing, it becomes proper planning. Fundamental tells us why, and technical analysis tells us where and when. One last thing I want to share with you: if you are only look at charts and ignore fundamentals, you are seeing only half of the picture. But when you understand fundamentals, market moves no longer feel surprising, they start to make sense. If you want me explain interest rates, inflation, and major news events with real trading example in the next video, then like this video, subscribe to this channel, and let me know in the comments which topic you want to next. See you in the next video. Take care and bye.